everyone. Welcome back. In this clip from our November webinar, I break down Fishbowl's 4 costing methods: FIFO, LIFO, average, and standard, and the hidden issues each one can create. Let's dive in.
Fishbowl supports 4 different costing algorithms, and those are LIFO, FIFO, average, and standard cost. And you typically make that decision when you're setting up the file. And if you're unsure on how to find out what costing method you're using, we come here to accounting integration, tools, module options, in the costing tab. And once you've made that decision, it's more or less permanent. However, Fishbowl support can change that costing algorithm for you if you decide to do something different. I favor average costing because it's the easiest one to fix. When I have a FIFO mistake, I have to cycle count out my entire inventory and then add it back in at the correct cost. If I have an average costing mistake, all I need to do is come here to inventory and click on this nice little pencil, and I can change my average cost. Okay, and then standard cost is a great costing method for my folks who are manufacturing things like food products and what have you, because it gives you the expected cost, and we can track variances, either variances in the cost of materials or variances in the cost of production. However, standard cost is the most labor intensive one because it is not automatically calculated by the system. It has to be manually entered in for each part number or uploaded. So when I'm in a standard cost environment, my cost is manually input right here. So, and then the FIFO costs and the average costs are calculated by the system and updated by the system. So Fishbowl, and then there's another thing about average cost. When my quantity hits 0, my next buy becomes my new average cost. I've had clients where their quantities never hit 0. In particular, it was a cosmetic company, and they were paying more for their ingredients when they were a smaller volume. And as they geared up, they got volume discounts and their ingredients became less expensive. But because their quantity on hand had never hit average, their average cost was actually higher than what they were currently purchasing it for. So sometimes those need to be adjusted. I have here, Fishbowl has this nice valuation report called Costing Layer Valuation, which shows all the different layers that go into either the current value or the historical value. I found that this was great, except for it's like, okay, where did this come from? So what we did as part of the controller's toolbox is we took this basic report and we put it together so it shows you all my history, plus it's flat. I can take this to Excel easily. It shows me the transaction that created the costing layer, and it compares it to what's in the standard cost field to get me a differential. So even if I'm not using standard costing, often I will populate that standard cost field just so I can see whether or not I've got an outlier on this. I originally envisioned this report to be helpful for the folks doing standard costs because once or twice a year, everybody needs to go through and evaluate their standards and make new standards. But I've also found this to be extremely helpful in identifying bad costing layers and other outlying transactions. So I'll zoom in a little bit so you can see it a little bit better. But what I've done is, one client, I've got this tied to the inventory module. So it's a quick report. You can actually see the history of what's happened on a part.
And that's how costing really works inside Fishbowl. If you found this helpful, hit thumbs up, subscribe for more Fishbowl tips, and click the link below to book a free consultation with me. See you next time.